Welcome to Business 7, Accounting for Small Business, Chapter 2, Analyzing Business Transactions. I will record two videos for this chapter to help you learn the material. In the first video, I will define a business transaction, give you a couple of examples, and I will present the fundamental accounting equation. We will define, identify, and look at the relationships among asset, liability, and owner's equity accounts. I will also define and identify revenue accounts and expense accounts. We will also record business transactions in the column form, so I will use a made-up problem to do that. In the second part of the video, we will talk about three financial statements: an income statement, a statement of owner's equity, and the balance sheet. And this is the core of the entire course. One of the major goals is for you to learn how to prepare these three financial statements for a sole proprietorship and also how to read them. Okay, let's start going. So define a business transaction. Business transactions are building blocks of our accounting system. In reality, if you have your own business, you have tons of source documents. You have invoices, check numbers, sales slips. In this class, the actual transactions will be given to you. And this is a definition of a business transaction. It's in any financial event that changes the company's resources. So it has to directly impact our firm. It must be expressed in monetary terms. For example, if we hire an employee, it's not a business transaction because it cannot be expressed in monetary terms. Therefore, we will not be able to analyze or record it. But if we pay the employee after 1 week's work, that's an economic or business transaction. And we will analyze business transactions in this chapter, in chapter 2, using a column form. And then again, we will analyze business transactions in the next chapter, chapter 3, using so-called T accounts. And in chapter 4, we're going to record these business transactions in our books. And we will use the general journal and the general ledger. But that's again coming up in the future chapters. And guys, every business transaction, this is very important, will have at least two impacts on our accounts. I will show you examples, but again, it could have more than two, but it cannot have just one impact. We are using so-called double entry accounting systems, so every business transaction will increase and or decrease. So, two accounts could be increased, two accounts could be decreased, so one could go up, one could go down, but it must be at least two accounts that are impacted. So here are a couple of examples. So let's say very simplified examples. Our business purchases a car, an auto, and we pay $20,000 cash. The two accounts impacted are the auto. We will call it an asset. It goes up. We acquire it, so it goes up by $20,000. Another asset account is cash. We pay cash, and that one goes down $20,000. There are your two impacts. One goes up, one goes down. A little bit different example, we buy an auto on credit. I'm simplifying here, I'm not talking about loans. So we're paying with, let's say, credit card. So now an auto goes up $20,000. And an account called accounts payable, AP, also goes up. And we will call it a liability. So we have two accounts impacted. In this example, both of them go up. So that's fine, but we have two impacts, two effects on our accounting system. We could have more than two impacts. We purchase an auto for $20,000. We only make a $5,000 cash down payment. Down payment means cash. And the rest we put on credit. So there are three accounts impacted. Our auto increases by $20,000. Cash goes down by $5,000. And the accounts payable account goes up by $15,000. So there are three accounts impacted, two of them go up, one goes down, but we have at least two. In this example, we have three accounts affected. Okay, let me present the fundamental accounting equation and talk about assets, liabilities, and owner's equity. I already mentioned assets and liabilities on purpose here. So this is the equation. By the way, we will not have that much math in accounting. A lot of students are scared of accounting because they think that we will have to use a lot of math. This is as much math as we're going to use. This is the simplest equation we're going to have. The math is very basic here, so we will not have to worry about calculus or anything like that. Okay, so assets that the business has must be equal to liabilities plus owner's equity. And these are the definitions. So the assets are property that we own or control. It doesn't matter if we paid it off or not. If we have a title, like you buy a car and you have a title for your car, it doesn't matter if you're still paying off on the loan, that is your asset. It doesn't matter if you paid it off or not. So the left part of the equation shows what you have, what you acquired, your property, your resources. The right side of the equation shows you how did you pay for it. So liabilities are claims of others against your assets. It's the claim of the bank against your car. So we call it liabilities. Usually in everyday language we use the term debt. We can use them interchangeably. And the claim of the owner, how much is your equity in your car? How much is your equity in your house? How much have you paid off? That's owner's equity. Notice here we have one apostrophe because we are looking at one owner's business, a sole proprietorship. So it's the owner's claims of financial interest in the business. You can think about it as a net worth. Another way to look at equity is whatever you have minus what you owe gives you net worth. And your net worth could be negative, right? So again, equity is sometimes called net worth, and it could be expressed as assets, what you have, minus debt, minus liabilities. Again, So the left side represents what you got, what you purchased, what you acquired, what you own. The right side of the equation represents how did you pay for it, or so-called financing. How much did you finance yourself versus how much did you finance by borrowing, by debt. So recall this example when we look at this last one, when we bought an auto for $20,000, paid off $5,000, and we borrowed $15,000. So if I look at the accounting equation, just focusing on one transaction, so my auto, $20,000, is my asset. This is what I bought. I borrowed, I'm sorry, here I made a mistake. I borrowed $15,000 on it, right? My down payment was $5,000. There we go. My down payment is $5,000, so that's my equity in the car. This is my claim against the car. The car is $20,000. How much is my claim? Out of 20 is $5,000. And the rest I borrowed from the bank. So how much is my lender's claim? Bank is my lender. So my bank's claim against my asset is $15,000. As I start paying off, my principal, my equity will go up, and my amount of principal, my amount of liability, so that will start going down. In general, when I look at this structure, this is the financial structure, I want to see higher equity and lower liabilities to appreciate how healthy financially my business is. So I hope now it makes sense. This is very simple. Just instead of one asset, we will have multiple asset accounts. Instead of one liability, we'll have multiple liability accounts. And here are examples. So we will start with a very simple service business in the first 6 chapters, meaning we will not have to deal with purchases of merchandise. We will not have to deal with inventory. We will study merchandising, retail businesses starting chapter 7. So right now we will not have that many accounts, but these are examples of asset accounts. Cash, auto, land, building, equipment, supplies, prepaid expenses, accounts receivable. So accounts receivable is probably something new, AR. When we sell on account, we are Apple, we're selling a computer, and we're giving the customer 6 months no cash, 6 months. So we record it as accounts receivable. These are amounts that we earned but have not collected yet. So if we sold it for cash, it would be increased to cash. If we sold it on credit, meaning we are giving some time to the customer until they have to pay us cash, we will increase AR. Prepaid expenses is weird. Ignore the word expenses. If you see prepaid, it's an asset. And it could be prepaid insurance, prepaid rent. So if I pay for the future insurance use, it's actually an asset. In our personal finances, we don't think about it that way. But for business purposes, we have to think about it as an asset, not an expense until it expires. Because again, if you think about prepaying your insurance for 6 months, you can cancel it and get your money back. So that prepaid insurance is not an expense until every month is completed, is finished. In the same way, when you buy supplies, I buy pens and pencils. It's not an expense because I just bought them. It's an asset called supplies. At the end of the month, I will see how many of those pens and pencils I've used up. Whatever is gone, used up, thrown away to the trash can, that becomes a supplies expense and it's a different account. And another difference I want to mention here, the difference between equipment and supplies, like equipment, building, land, auto, all of these are long-term assets. We're going to use them for more than a year. Supplies we will use in less than a year. So it's a short-term, or we will call it later, current asset. Okay, so these are some of the assets you will see. You will see only one liability account, I think, in the first 6 chapters. It's just going to be AP. So AR are the monies or assets that are owed to us, that I will collect. Accounts payable is what I owe, I have to pay. So account receivable is what I will receive, it's an asset. Account payable is what I will have to pay. I have to give up a cash payment usually. If you look at all liability accounts, they all have the word payable. So that's how you identify them. Very easy to identify. There will be many of them, especially in chapters about payroll, but you will not really see notes payable or wages payable or sales tax payable until later chapters. So far, you will only see, I think, accounts payable, one account, but there are multiple liability accounts. Now, owner's equity is something that sometimes students struggle with. We really have 2 equity accounts. So as a sole proprietorship, we have one owner. So I'm Dmitry Kalagin, comma, capital. That's my equity account. And I have the opposite account. You could call it a contra account. And it's Dmitry Kalagin drawing. So it's any assets, cash or other assets that I take out of business. Capital is what I put in the business. Plus, we will talk a little bit more about owner's equity in the next learning objective. Let's move on. So the entire accounting process of analyzing, recording, reporting business transactions is based on this fundamental accounting equation. And if any 2 parts of the equation are known, of course, we can calculate, determine the 3rd part. So let's take a look here. If my assets are 52,500 and my liabilities are 16,200, so how do I calculate my owner's equity? I have to subtract, right? Assets minus liabilities, 52 minus 16, 42, $36,300. So I just subtract assets from liabilities. And guys, stop for a second and look at this financial structure. If you just briefly, very briefly look at this business, it doesn't really matter how many assets they have, because you can borrow a lot of money and have a lot of assets, but most of it is not paid off. You look at to determine the health of business, to look at its financial position, we look at the relationship between liabilities and equity. And you can see our business has more than twice as much equity as liabilities. So I would say this business is pretty healthy. Next example, I don't know assets. So what I do, I have to add liabilities plus equity. So it would be 60,000 650, right? For assets, I just add them together. Again, I cannot say that business number 2 is better than business number 1 because it has more assets. It has nothing to do with it. I have to look at the structure, and you can see that the second business has, 4 times more debt than equity. So actually, the first business is healthier than the second business. And then the last example, we know the assets, we know the equity. What are the liability? You subtract them. 100,000 minus 63,000 will give me $37,000. And again, if I look at this business, it has, much more equity than liability, which is a good thing. All right. So the question here, before we move on, if I look at my fundamental accounting equation before, right, the main reason I go into business is to make profit. And where is the profit here? So the profit is actually hidden in this owner's equity group. So to calculate my profit, and we will use the term net income, it's the same thing, profit or net income, but we call it net income. What we need to identify and define and list separately are revenues and expenses. And here is a definition of revenues. Revenues could be called sales. It's the same thing. Doesn't matter how you call it. Revenues or sales. It's an inflow of money or other assets that results from the company's operations. So it's an inflow, incoming, positive coming, money or other assets. It doesn't have to be cash. We could have, barter from the sales, from the operations of the business, normal operations. And guys, these are accounting titles. These are names of these are names of accounts that are revenue accounts. So far, up until chapter 7, you will only see this account, one account, fees income. But in reality, the business might have multiple revenue accounts. Anything with the word fees, that's revenue. These are not fees we are paying. These are fees we are charging customers. Anything with the word fees or income or sales is classified as a revenue account. And the opposite of it is expenses. As we are earning those revenues, we are incurring expenses. A very important verb, incurring. It doesn't matter if we pay for them yet or not. Expenses are amounts of assets that we use up as a result of operations. In order for me to make a sale, I have to pay salaries. I have to rent an office. I have to purchase utilities. I have to pay for my phone bills and so on and so forth. I have to pay for insurance. So expenses are amounts of assets that a business uses up as a result of its operations. And guys, they're very easily identifiable. They must have the word expense. So again, the account supplies without the word expense is not an expense, it's an asset. But with the word expense, it becomes an expense. So you must always, you can abbreviate it, but you always have to use the word expense when you're talking about expenses. And there are many of them, and you will see multiple types. So what is revenue minus expenses? That's the main reason we go into our own business. That's net income. Again, what's the formula for net income? It's revenues, total revenues minus total expenses, nothing else. So net income could be called profit, it could be called bottom line. We will use net income, but any of those terms mean the same thing. So if revenues are higher than expenses, we have net income, we have profit, we are in the black. It's a good thing. If my revenues are less than expenses, we're in the negative, we're in the red. We will call it net loss. So net income versus net loss. I hope it makes sense. And so guys, in addition to my capital and drawing account, if you think about the relationship of revenues to equity, revenues increase my capital. When I earn revenues, my capital goes up. So revenues are kind of a subgroup under owner's equity. I sometimes think of owner's equity as an umbrella. And under that umbrella, you have capital, drawing, and then subgroup revenues and expenses. Revenues are increasing our capital, expenses decrease our capital. So expenses do the opposite. So if we have net income, we will add it to capital. In chapter 6, we will transfer it to capital. If we have a net loss, we will subtract it from capital. So that's the relationship between revenues, expenses, and owner's equity or capital. So guys, if I take revenues, expenses, and drawing and move it out of my umbrella of accounts, right? Out of my umbrella of accounts, this. So I will have only capital left. So under equity, I keep only one account, capital, and I take red, revenues, expenses, and drawing, and list them separately. This becomes my expanded accounting equation, and I promise this is it. This is as long as this equation is going to be. So I have three permanent main real accounts: assets, liabilities, and owner's equity. And I do want to mention, really, in owner's equity, you only have one account. You only have capital left there, right? And then the blue accounts, we will call them temporary. They really belong to equity, but we list them separately so that we can keep track of profit. This is my net income or net loss, my revenues and minus expenses. Notice the negative signs before expenses and before drawing. Negative signs, right? They are subtracted, red. Okay. So now we have set it up so we can record business transactions in the column form. The idea is that, again, every transaction is a business event, business transaction, right? And it will impact at least two accounts, and one will increase, one will decrease, or both can decrease, or both can increase, but my equation must stay in balance. This is the main thing, right? I have to be in balance. When I record a transaction, it will go into two places, two accounts. Both of them could be assets, or one could be asset, and one could be expense, or one could be asset, another could be liability. But I have to be balanced. My left part of the equation must be equal to my right part of the equation. Left and right, they must be equal. Okay. So we will go in the first 6 chapters through this accounting cycle, and the company has to finish it every period. For a small business, we need to do it every month because there is a high chance of a small business failure. So in this chapter, chapter 2, we're going to cover step 1. Right now, we're going to talk about transactions analysis. And then in the second part of the video, I will show you financial statements. And then, guys, other steps we will cover in chapters 3, 4, 5, and 6. So let's talk about analysis of transactions, analyze transactions. We will follow these 4 steps, look at them. So you will read the transaction, you will decide which 2 or more accounts are impacted, you will decide their classification, meaning are these accounts assets, liabilities, equity, or revenue, or drawing, or expenses? Are they increased or decreased? And make sure you're equal, you're in balance. So I just want to go to a problem. Let me go right here. It's a made-up problem. You cannot find it in your book. So we have July 1st, Alfred Heron established his appraisal services company, and we have this transaction. So we will go over each transaction and we will put it in the column form. This form will be given to you. And guys, look how it's set up. So we have 11 transactions. We have 1, 2, 3, 4 assets. So they're making it easier for you. Later, you will have to identify accounts. But here, they tell you, you have 1, 2, 3, 4 assets to choose from. Right? You cannot make up your own accounts, and if you have this column, it has to be impacted somewhere. You have only one liability account, accounts payable. And guys, in this problem, we are not separating revenues, expenses, or drawing, so we will put everything under capital. In some problems in your homework, they will have additional columns for revenues and expenses. But here we will put everything under capital. If it's a revenue, capital goes up. If it's an expense or withdrawal, it will go down. Okay, so the owner invested $96,500 in cash to begin the business. Remember in chapter 1, separate entity assumption. We are doing books for our business. For the owner, it's a minus to cash, but for his business, cash goes up. So I take this $96,500 and I add them in cash, and it's his own money, so it increases capital. So every single business must begin with these types of transaction, sole proprietorship business. Cash goes up, equity goes up. Cash is up, capital is up. Are we in balance? This is the equal sign. The left side is equal to the right side. We're good. Both go up. So if it's a minus, we will put a minus sign. If it's a plus, we can leave it without the plus sign. Second transaction, we paid or I paid. I always say add the pronoun I. I paid cash for the purchase of equipment. What are the two accounts impacted? Cash, I paid 19,650. You see, I put the minus and it puts it in parentheses. In accounting, we don't like to use minuses because they're easy to miss. So we usually identify negative amounts with parentheses. But I paid cash. Cash goes down, right? I paid cash. Cash goes down. And I purchased equipment. I have more equipment, so equipment goes up. And that's it. This is not an expense because I haven't used this equipment yet. And look what happens. One asset is down and another asset is up. So what's the change to total assets? 0. So do I need to put anything on the right side? Nada. Is my equation in balance? Yes. Assets have not changed. I redistributed the assets. I took out from cash and put it in equipment, but my total assets have not changed. I hope it makes sense. So make sure you understand this transaction. It's all about practicing, practicing, practicing. It's just like sports, athletics. You have to get them. You have examples in your textbook. You have examples in your homework. Practice, practice, practice. And guys, right now you probably only have about a dozen of types of transactions. You have to understand all of them. Don't memorize. Make sure you comprehend it. I purchased additional equipment on credit, 14,200. So my equipment goes up, but on credit means that I did not pay cash. I bought it from somebody and I will have to pay later. So the phrase on credit or on account, bought on account, means I have to pay later. So it's accounts payable. Guys, also positive. It's like, think about it, and it's not necessarily true, but for now, you use the credit card. You bought equipment, equipment is up, and your credit card balance is up. And AP is a liability. Look, are we in balance? Yes. Assets went up and debt, liabilities went up. So I am in balance. So both accounts increased. Transaction number 4, I paid 11,700 in cash to creditors. Think about it, I paid off my credit card, right? Paying cash to creditors, 11,700 negative, right? Paying cash means cash goes down. And guys, I paid it off, so my credit card balance also goes down. Make sure you understand it. Paying off this transaction means that both accounts decrease. My cash goes down and my balance of credit card goes down. Another way to think about it, this is your credit card bill, 14,200. Now you're paying off 11,700, so you still have like, what is it, 2,500 balance left. So both accounts go down and it keeps my equation in balance, right? The left side went down and the right side went down. Okay, next one. The owner made an additional investment of 29,500 in cash. This is the same as the first transaction. Cash goes up and capital goes up, nothing to it. So we are in balance. And then the next one, I performed services in cash. The phrase performed services or provided services or billed the customer means revenue. I completed a sale. Performed services means revenue. And then you can perform services for cash or you can perform services on credit or on account. So number 6 is for cash. So 8,100 cash goes up. I made a sale, a revenue, and the customer paid me cash. And guys, it's a revenue. Since I don't have a separate column for revenue, what does it do to capital? It increases my capital. We talked about it, right? So revenue is a plus to capital. Both sides go up, the left side and the right side. But in transaction 7, I did perform services, so I have to record revenues, $6,100, because it doesn't matter if I got paid cash or not. I have to record revenue. But I did not receive cash, so which account am I going to use? That's correct. We're going to use accounts receivable. So when you look at the company's revenues, and you see it's a huge, nice revenue, it does not mean that the company actually got paid. So a company, small business, could have a nice net income, but might not have enough cash to operate because they are not collecting fast enough. So just having net income does not mean the business is doing well, because cash is the king. So in this example, we did receive 8,100 in cash, but 6,100 we have to collect in usually 30 days, 45 days, whatever our credit terms are. Transaction number 8, I paid 39 for rent expense. I paid, cash goes down, I paid 3,900 minus 3,900. And guys, this is an expense. I don't have a separate column, so I'm going to put it as a negative against capital. So when we have expenses, what happens to capital? It goes down. The left side of the equation went down, and the right side of the equation went down. So whenever you pay cash, cash goes down, expenses go up. Expenses increase, right? But my capital decreases because expenses have a negative impact on capital. I received 34 in cash from credit clients. Yay! I am collecting from this 16,100. Look at this transaction. This is a collection. I receive cash from credit clients. The major mistake, students think it's revenue. It's not. Revenue happened right here when I performed services. And days later, the customer pays me. It's not revenue again. It's simply a collection. So what happens? My cash goes up, 3,400, and my receivables go down. I have received, so it's no longer receivable. What's the balance I have to collect? Right here, 2,700, right? I sold 6,100 on credit. I've collected 3,400, so I have 2,700 still to collect next month. It does not impact my revenue. The entire amount of revenue was already recorded. Make sure you understand it, the collection. And guys, again, cash is up, AR is down. What's the change to total assets? Nothing. Do I need to put anything on the right side? No. Because if you put anything on the right side, your equation will be off. Make sure you understand it. And then two more transactions. I paid 63.16 cash for office supplies. 63.60 negative. Guys, this is not an expense. Remember, we talked about it. I am buying supplies and I have them. I have not used them yet. It's my asset. I have not used those supplies to earn revenue. The definition of expense is the amounts of assets we use up as a result of our operations. I will be using these supplies later, and then later in chapter 5, we will expense some of them out. But right now, one asset is down, cash, another asset is up, supplies. No change to assets, nothing on the right side. It's not an expense. An expense happens when it says, I paid, for rent expense. I paid for insurance for this month, or I received the bill for utilities, or I paid salaries, because it's after the fact, right? Whenever you prepay something, if you prepay salaries, if you prepay insurance, if you prepay rent, that's an asset. It's not an expense. And that's the difference between our personal finance and business accounting. And the last one, the owner now takes out, ooh, nice, $8,900 for his personal expenses. Again, from a perspective of a business, cash is out, down. It's a plus to the owner, but to the business, it's a minus to cash. Minus $8,900. And guys, it goes into drawing as a positive. Drawing goes up, the owner's name, comma, drawing. But we don't have a separate column, so I'll put it as a negative because drawing has a negative impact on capital. And here we are. So you can see here, guys, we've got total assets. We started with this much cash. We have less cash, but we have receivables to collect. We have supplies and equipment. We have very little liability, and we have a lot of equity. I mean, this is quite unrealistic, but it's looking really good for this business. So these are building blocks, these business transactions and their analysis, and putting them into appropriate accounts. Every transaction must impact two accounts, sometimes more than two. So this is the core of this part of the chapter. Thank you so much.